everyone. This is Avijit Chatterjee and Rohan Singh. We're recording our Charts Are Fun weekly session. This is for the week of July 15th. Today we're recording it after the market close on the 19th. Well, we finally got the pullback. This market has been really on a tear. We know that S&P, QQQ, all were shooting up like no tomorrow. And finally, we even got the small caps get a huge bid. The small caps took off after last Thursday's TM CPI. We finally got a month-over-month negative print on CPI, and small caps absolutely took off. So there was a bit of a rotational trade going on, money moving into small caps, and even the Dow Jones Industrial Index, which has been lagging, took off thanks to the United Health's earnings. But today, and in fact, the last couple of days, because of options expiration and typically seasonality-wise, every month during options expiration for Max Payne, we did get selling. We did get quite a bit of selling. So you can look at where the market is headed. In particular, we look at small caps. Tom Lee was on CNBC. He's made a bold prediction of 40% upside in small caps over the span of next 10 weeks. We're going to look at that. We're going to look at 10-year yield. I've often talked about that as a barometer of the market. Treasuries is where influences the biggest kinds of retail spending. We as consumers take loans to buy stuff. So looking at interest rates, looking at where the Fed is headed with interest rate projections and cuts is key. And in fact, the reason the markets in small caps did take off was the fact that market is quite sanguine now, about 100% sanguine that 100% sure that they're going to get a rate cut in September. And then maybe 2 more cuts is now also being expected in, there's no October meeting from September, going to November and December. So we're going to look at 10-year yield chart. We'll also look at QQQ. We know that that by far has been led up by the Magnificent Seven, the trillion-dollar mega cap stocks. But recently they've had a pullback, taken a bit of a backseat while the broader market has been taking off. So we're going to look at QQQ. We're going to look at Qualcomm, which the semiconductors recently been hit quite a bit, but Qualcomm looks quite attractive. We look at where we think Qualcomm could be an attractive buy. And then the Bitcoin, the favorite miner there is Mara. We look at Mara's chart. And finally, I'm going to also share the favorite meme stock, Gamestop. It had a nice breakout this week, did pull back, but I think there's more upside coming in GameStop. So we're going to look at GameStop as well and its chart. So with that, let's just share my charts and go through the interesting patterns. So first of all, I'll point you to our YouTube channel, Charts Are Fun. This is really our weekly videos you can find in here. We hugely appreciate if you could subscribe to the channel, and also if you like the videos, if you could hit the like button. We really appreciate that. Also, our blog site at Substack, chartsarefun.substack.com. We do publish daily blogs, and very recently I added a section on Charts Fest, call it, along my favorite technician, Helene Meisler's idea of charts, key charts on key sectors that I would post, drawing trend lines and showing where things are headed on Saturday. So we had one July 13th, we had the one the week before, and I'm going to publish one tomorrow as well. So look forward to you looking at those blogs. So I talked about the 10-year Treasury, and this is the weekly chart of 10-year yield, TNX. And we can see that if we take the rising lows and draw a trend line through it, it touched 2.52, 25.25 is 2.52% around August of 2022. And since then, it has been pretty much a sequence of higher lows. So if you draw that trend line, in many ways, this is a neckline. And then you could say that the left shoulder from there from 2.52 went to 4.3, 4.33, pulled back to 3.29 or 3.3. Then we got the big move as inflation kind of peaked, and expectations for interest rates for higher for longer was very much around. 10-year yield hit as much 4.99. In fact, after hours, it even crossed 5%. Then it pulled back again. This was a very sharp pullback. In particular, the early part of December, Powell came in and talked about pivot. He talked about 3 cuts potentially in 2024. Market got excited, thinking not 3. Market started expecting 6 cuts for the year, and that brought the 10-year yield sharply down from 5% down to 3.78. From there, the first part of the 2024, we had hot inflation data, a lot of it coming from shelter, from auto insurance, from some of the services related numbers, and that caused the 10-year yield to go back up towards the 4.73%. And then we've seen a steady pullback as inflation started cooling. And in particular, the report that came out last Thursday, CPI came out with a negative print month over month. That helped the small caps take off. Small caps are very interest rate sensitive. And the 10-year yield came back to touch the trend line here, which is now rising, right, as the lower, as the higher lows are printed, the trend line is rising, and it's now closer towards the 4.15%. And that's exactly where it rebounded off at 4.144, 4.15, and then it kind of closed up 1.19% for the week, closer towards the 4.23. Now here, this is a slanted pattern, guaranteed. You're not talking about a classic head and shoulder where the neckline is usually horizontal. It's kind of a slanted upward sloping trend line, but this is the left shoulder, then we have the head, and then the right shoulder. If this breakdown does happen, we're talking about a 2.57, which is a significant drop from where we are today. That's almost like closer towards 1.6% of yield dropping, and that's more than 6 cuts. 6 cuts from this level here. If you start from 5.25 is where it is, you're talking about significantly more, 10 to 12 cuts. That actually is very bearish if this does happen. This could mean safe haven buying. It could mean economic collapse, some severe recession. So while the technical pattern says that this is a possibility, I think it's a very low probability that we'll get a head and shoulder breakdown in here. But that cannot be ruled out. Now, if you look at how this impact the the TLT, which is the long-term Treasury yield, TLT actually has a bullish ascending triangle pattern. So for those who are looking to be conservative, knowing that the market has come up a lot and expect a correction, which seasonally does happen in the months of August and September, this could be a place to kind of park your money. TLT is kind of ripe for an ascending triangle breakout. So here we see a horizontal resistance line around 94.5, and then the lows are rising, 86.4, 88.1, the recent low early July, 89.8. And if that break above 9.45 happens, we're talking about a projected target near 102.6, 103. So that is where some of the conservative traders may consider as a way to play this breakout. And this kind of ties in with that head and shoulder breakdown. So if TNX breaks down, there's a good chance that you could get a breakout in TLT and it could go higher. Now, all of this correlates to Tom Lee's projection on small caps. He is looking for a decent upsides in the small caps. He was interviewed in CNBC this week. He's talking about, his earlier projection was for a 50% gain in small caps. This was towards the beginning of the year when he made that bold prediction. Now he's talking about the fact that the low June CPI has given the green light to the small caps to finally take off. He expects a closer to 40% rise in IWM compared to 27% gain the IWM had from October to December. That was over an 8-week period. So let's just look at the weekly chart to see what he's talking about. So this is when from 161 to 205, that's a 27% rise that small caps had in a span of 8 to 9 weeks. Now with this breakout, we just got a breakout above the previous resistances, 211.88. We got a breakout, we touched 226 this week and pulled back. But this breakout he expects will continue. This is just the early part of that breakout. This is the second week. He expects this to continue for next 8 more weeks for a duration of 10 weeks. And he expects that 10-week duration could take it as high as closer towards the 40% move. Now, if you look at the longer term weekly chart of the Russell 2000 ETF IWM, you could say that this has got a beautiful base from here near 212. It touched 162.7, 162.5 twice. So 162 held a solid support. Then it retested that in October of last year at 161.67. It dipped slightly below it, but then RSI never weakened to too much below 30. It stayed steady, holding the 30 level, and then it moved higher. So from 161 to 211, that's a 50-point move off this base. If the breakout continues, the measured target is at 50 to 211. We're talking about 261. So that's the movement that we could expect. So now that it has pulled back to 216, another 45-point move can take it towards 261. So 45-point move from 216 is a little more than 22%. So that's the kind of upside left in small caps. And Tom Lee thinks that this could happen very quickly over the next few months. And he expects small caps to continue the bullish momentum. Maybe all that the small caps are waiting for is that Fed signal. We have the FOMC meeting on the 30th and the 31st of July. If Powell comes in and turns out to be very dovish, the concerns of dovishness that the market thinks is primarily the unemployment rate going up to 4.1%, and then the negative print on CPI last week for the month of June. Market thinks that this has now come too far with interest rates staying too high. It's eventually going to break the economy. We're going to start getting recessionary fears, and Powell and crew will start now thinking about cutting in earnest. They may not do it in July, not to surprise the market. They've been indicating September is the first time they'll go do a cut. So if the market gets confirmation from the Fed that, yes, they will start thinking of the cuts from September, and maybe even indication of 2 or 3 cuts expected for the year, this could help the small caps continue their rally. And so we could have quite a decent rally in the small caps in the month of August. And what Tom Lee is expecting is the S&P 500, the mega caps, to take a bit of a breather. So he would not be surprised to even see flat to negative print in S&P. But before S&P prints that flat to negative print, he expects some more upside in the S&P this month. He expects S&P to head closer to the 57 to 5800. We know that we did get a pullback on S&P below the 5600. It was recently at 5660. It has pulled back to 5550, and he expects that this was just a correction, seasonal correction. Typically, by the way, this is Stock Traders Almanac. If you look at seasonality week by week, from July 17th to the 24th happens to be one of the weakest weeks for the entire year. So no wonder we've seen this pullback. We also know the cause of this pullback has been the tariff fears that the semiconductors got hit. Trump is talking about tariffs, Taiwan not being protected if they don't pay for their security. Biden started enforcing the imports of, exports of U.S. technology into China. He's kind of, talking about cracking down on that. So the semiconductor, and then ASML had kind of not a strong forecast they had strong earnings, but not a strong forecast as much as the market expected. TSM, however, was extremely strong, extremely bullish. They raised their forecast, but that didn't impact because the Taiwan news that Trump might start forcing them to pay for their protection, for US protecting them against China, shook up the TSM, and the chip industry got pulled back. And then we got just the overall pullback from options expiration. This is a key options expiration week. Typically, there was a lot of call buying going on, speculative call buying, and money managers typically to hone in on those calls because they are the other end of the trade. When people are aggressively buying those calls, the big money managers are the ones selling the calls, the market makers. The market makers hence bring the price down, and that makes these calls all worthless. So that means they don't end up losing the underlying stocks that are tied up to the calls, and they don't end up having to pay the premiums either. So this was a classic, call it options expiration related manipulation move, brought the stock prices down, and hence we got the sharp pullback. Now, overall, this candle doesn't look very bullish. It's kind of a bearish tail, long tail on the top. So we have to look out and see the lows of this week was 214 on IWM, if IWM prints a lower low for the next week. But if it maintains a higher low and in fact starts resuming its climb, volume was pretty high. Volume was also high on the previous week when it broke out from the low 200s to the close towards 214, 215. And then this week, early part of the week, it hit 226 and then kind of lost some of that. So let's look at the hourly chart of the small cap ETF IWM to see exactly how that breakout happened. Well, we can see right here, July 11th was when the CPI printed. That was when we got the month-over-month negative print, and IWM took off. Beautiful climb, solid volume. We can see these black candles indicating volume, heavy buying at the gap open, continued buying for the next several days till we got the peak on the on Wednesday, the 17th. From there at 226, we've got steady selling. So there was the first part of the week, rotational money movement, money moving out of Nasdaq, money moving out of the mega caps into small caps, and that's the rotational movement. And then we got a bit of a pullback. But in that pullback, if you notice, the heavy selling was not as much as the stronger buying when you see these black, candle volumes on the stronger parts of the buying. So yes, the pullback was healthy. We got a pullback to test the 50 period moving average, and 215, 216, as you notice, was the kind of now the previous resistance is now support. It kind of successfully held that, and perhaps we get a climb again next week. Maybe we resume the climb, and the expected target, as I said, on IWM is 261. So this could be where we are headed. However, Lizanne Saunders was out there on CNBC. She was also on risk reversal, the one that Dan Nathan and Guy Adami runs from the Fast Money crew. She talked about don't just chase IWM as a moniker, the 2,000 stocks. They're not even 2,000 stocks. They're about 1,800 or so stocks in that index. But pick the good quality names. So there is an interesting ETF called the CAF, CALF CAF, and that focuses on cash flow. Look at the 100 among the small caps, in fact, this is not just the Russell 2000, but small cap 600 index. Look at the 100 best companies in there in terms of the best free cash flows. And that ETF actually is a much, much more safer investment if you really do have to play these small caps and invest in the small caps. This shows a beautiful cup and handle. So 47, pull back to 42, up to 47. Now recent shallow pullback to 45, and holding its nice 20, this is a daily chart, so the 20-day moving average. The 50-day moving average is in blue, the 20 days in red. It had been downward trending from the March 49 to the 42. It came back to 47. So if you do 42 to 47, that's 5 points. Add that to 47.32. You're talking about closer to 52.5. So it's about 5 points, 5.13, 5.13 added to 47.32. That's closer to 52.45. So that's where the target of this is, and this is a safer, and we can see that the pullback came on lower volume. The big breakout that we got last week, in fact, we got this big breakout not last week, we got it this week on Tuesday. This is when we got a massive breakout. The whole upward movement happened last week, but this Tuesday we got a big move out, and we went all the way across from the 44 all the way to 47, pullback in lower volume, declining volume. And this is perhaps CAF is the recommended ETF if you do want to invest in small caps, much safer place to invest in. For the aggressive traders, however, one way to play this big upside move in these IWM is to buy TNA. TNA is a leveraged ETF, 3x the IWM, and this has very good upside as well. So if you look at the key breakout that happened in here, it broke out from 31 to 41. This is just the daily near-term chart. That measures closer to 51. It did get close to that, and it's pulled back. However, after it's testing the 43.65 level, which it tested today at 43.46, this turns out to be key support, which is resistance before. And if this resumes its climb, you can expect this to move much higher, closer to maybe 65, 70. So for those looking at, because it's going to, if you're going to have a 30%, or we talked about 22% move in IWM, that means that translates to 3 times 22, 66% move in the TNA. So add a 66% move on top of 44. That's closer to roughly another 28 or 28, 30 to 44, and that's closer towards 72 or something around that. So that's potentially where this could be headed, and this could be a great aggressive move for those looking to invest in the small caps. Now I'm going to move into QQQ, which is a great trend line as you draw the trend lines with the lows from April. 412.41, 419.96, 442.35. We were expecting this to hold that trend line, and till last week, this is daily by the way, till yesterday, it did hold the trend line, and then today it broke below it. The trend line is somewhere near 477, and the measured target is also 477. So 490 to 503, that's 13 points. Subtract 13 from 490, that's 477. However, we kind of was hovering around there till yesterday, and then today we broke below it and closed below it at 475. So that's a bit of a red flag. It did break below a trend line, but if it reclaims it next week and resumes the climb, we could expect it to go back and try to close that gap near 490 in the next few weeks if earnings is strong. Because remember, the big technology, the Magnificent Sevens are going to start announcing earnings. Tesla is coming up next week. Netflix was pretty reasonably good in earnings. The stock actually had touched up and then pulled back by the end of the day because the overall options expiration caused big sell-off in the markets today. But maybe Magnificent 7 earnings could be decent and we could resume a climb of QQQ back to at least close that gap closer to 490. And then my measured target on QQQ is 520, by the way. And this is the long-term cup and handle pattern. So there's a possibility that we could still head there and test that out. If I go here and I think I look at QQQ, QQQ's weekly cup and handle, that's the 520 I'm talking about. So this is the cup from 401 to 251 to 385. That handle from 385 to this pullback and then broke out. That 520 is where I think QQQ could head. Now, one key stock that is not a Magnificent 7, but a good, fundamentally strong semiconductor stock to play the AI, to play the big grades and cell phones coming in because of Apple's AI play is Qualcomm. This is a beautiful uptrending channel from 130 to 230. Draw that top of the trend line, parallel trend line through the lows as the higher lows happen. That came and tested not with as much volume as we got with in the previous weeks. From 230, very rapidly it's pulled back to the bottom of the trend line. And if you look at the target of where Qualcomm is headed, this is a beautiful cup and handle. 182 to 97, back to 177. That's close to 80 points added to 177. That's closer to 257. So that's where we think Qualcomm is headed. It didn't go up to their target yet. It touched 230, pulled back. It tested this beautiful rising 20-week moving average. As we can see, this is steadily climbing higher, very bullish looking trend. And if it doesn't break below and continues its climb back up, we could get a decent upside from 186 towards the 257 level. So that's closer to almost a 70-point move of Qualcomm from where it is. So that's something to look into as a bullish play in terms of playing the technology move higher. And valuation-wise and fundamentally looks extremely attractive. I talked about the Bitcoin. I talked about that the recent pullback last week I said was a bear trap. If any bears were thinking that Bitcoin was going to break in from a double top pattern and maybe go to 39,000, we got a very sharp rally in Bitcoin this week. And it resumed back climbing from the 56 low or 54 low that it 54,000 low that it had touched 2 weeks ago because of Mt. Gox and German government selling of Bitcoins. It had touched as high as 66K, pulled back a bit to 63K, but Mara had a massive, nice breakout this week. This is an ascending triangle I had talked about before. The top of the ascending triangle is 23. The rising lows broke out above 23, measures to 31.5. We got a nice move day before yesterday on Wednesday to 27.8. Couple of days of pullback, but notice the 23 level is holding nicely. So I expect this to resume its climb. For those looking to play, miners have been laggards in the Bitcoin play, but I expect Mara to continue its climb. Way to play Bitcoin is to look into investing into Mara. Now, coming into the meme stock Gamestop, which Roaring Kitty recently has quietened down on it. There's been discussions that he's probably has moved his investment from Gamestop into Chewy, which The common connection between GameStop and Chewy is that the founder, Ryan Cohen, founded Chewy, made his billions, then invested his money into GameStop, and now he's the CEO of GameStop. So Roaring Kitty moved from GameStop apparently to Chewy, trying to make an investment on that stock. And what might have caused him to be upset was when GameStop had their meeting, their shareholder meeting, they were very cryptic. They didn't provide a lot of information about where all these $4 billion of cash that was raised recently is going to be spent by Ryan Cohen, the CEO. So that said, the chart has a beautiful ascending triangle as well. This is the hourly chart. 26.7 was where the top of the trend line or the ascending triangle was. The higher lows from 22.3 climbing. That breakout actually measures to 22.3 to 26.4 is a 4.15 move. 4.15 to 26.45 is closer towards 30.6. We didn't get that. We went up to 29.79, 29.8 and got a pullback, but not as much volume in this pullback. I expect this to actually be a cup and handle with a bigger move coming. Why? We do have an excellent pennant forming. If you take the highs of GME, 64.8, 48, 29.79, the high that we got this week. The bottoms are rising, 17.7, 22.5. This week we got the 24.97, somewhere around the 25 level. This squeeze is going to come out. Typically, this is in the direction of the primary trend. We got high volume breakouts in the May timeframe. We don't know what the fundamental news is. Ryan Cohen does have plans to invest the cash, build something for the business to solidify, diversify, and grow the GameStop business in a very different direction. Maybe some of that might come out. Not sure what could be the catalyst, but there is a catalyst potentially popping up. And if this breakout happens, I expect this to actually break above 65 and go towards a 120 to test the previous highs from 2021. So for speculative investors, it's not as speculative from a pure balance sheet level, by the way. It's kind of an $8 to $9 billion company. $4 billion of that is in net cash with very little debt. So you're not really taking a big risk with respect to, if you believe in the CEO, Ryan Cohen, he's done an amazing job with Chewy. If you believe that he's going to come up with some brilliant idea, he's already significantly cutting costs, improving profit margins on GameStop. Maybe the stock has got huge upside. So I would look forward to a breakout in this coming any day now. This is a daily chart, so it's almost getting to the apex of that pennant, and a breakout could come next week for that matter. Don't know the catalyst, but it's a reasonably good stock to look for some big movement coming soon. With that, thank you for your time. Look forward to great trading, and we'll talk to you guys next week. Good luck with all your trading and investments.